Hi guys, welcome to Data Trading channel. Maybe you are looking for the trading strategy of millionaire traders to follow in their footsteps and make your brilliant journey. Or you want to compare your trading strategy with a successful trader who has made millions of dollars from trading to know your strengths and weaknesses. So episode is yours. Come with me to review and practice the trading strategy of a specific millionaire trader. Well, if you are asking who is he or she that made a lot of money with trading but reveals his or her strategy, I have to say he is Christian Klomagi. Christian trading account in 2013 had only $9,100, and by 2021 his trading account had grown to $82 million. Before continuing, please subscribe to the channel so you don't miss my other videos and hit like button. Like all of us, Christian had ups and downs. In the first years of his trading career, Christian lost a lot of money. He later discovered his breakthrough strategy and a good risk management system that allowed him to grow very well. His risk management is not complex and can be summarized in these steps. 1. Never enter more than 30% of a position overnight. 2. All positions should be between 10% and 25% of the account size. 3. The risk in each position should be between 0.25% and 1%. However, he added that when his trading account was much smaller, the risk per position was between 0.5 and 1.5%. In fact, he uses a swing trading strategy that works well on the daily time frame. The basic idea is that the stocks tend to move in steps. According to Christian, stocks tend to make a move of 20 to 50% in one direction, then pull back for a while before making another move. Christian typically looks for moves between 30% and 100% that last between 20 days and 3 months. Let's check the strategy on the chart. This is the chart of Bitcoin to USD on a daily time frame. Now, let's add some moving averages to the charts. Click on the indicator tab of TradingView and search moving average exponential. We need 3 of them, then click on it 3 times. Now we need to change some settings. Click on indicator setting of first one. On the inputs tab, change the length to 10. Then click the style tab and change the color to this. And next, for the next EMA on the input tab, change the length to 20 and change the color to this. And then for third one, set the length to 50 and then color to this. We use these indicators to know range market. When a price moves up and down between EMAs like this, it basically means that the market is simply consolidating or moving sideways. We know that this phase is not suitable for enter to trade, and if we have an open position, it's better to sell and wait for suitable condition. But how does he find the best position to enter the trade? The answer is in 3 steps. 1. He usually waits for a big bullish between 30 and 100%, ideally lasting between 20 days to 3 months. 2. The price returns to consolidation movement. This consolidation phase can be between 2 weeks to 2 months. 3. Wait for the price to break out of the range phase to enter a long or short trade. As you see, here's where we would enter a long trade. A stop loss should place at the lowest price of range phase. He usually sells a third or half of the position 3 to 5 days after entering for the risk management. As the price continues to rise, the stop loss is followed by the 10 or 20-day EMA, depends to which of them is support line. Here, the 10 days, this means that if the price breaks this line and crosses it, we should sell the rest of the position. In another example, you can see Shiba to USDT on daily time frame. Checked by Christian formula, we see this bullish move that rise about 60% during 28 days. That is matched by Christian rule. But there is a point here. If you see before this bullish pattern, you can see a range phase from here to here, but it's not exactly between three moving average lines. This is possible that you think this point is good for short position, but as you see, price come back and continue range phase. Because of this, setting a stop loss is critical. Another point is the more the lines are separated from each other, the more hopeful we can be for the continuation of the process. As you see, care must be taken as far as the distance between the lines becomes smaller. We should enter a long trade here, where the price started breaking out of the consolidation phase. Then for risk management, we should sell third or half of all our positions after 5 days. Then here you can see that the price closed below the 20 days EMA. So this is where we're gonna sell the rest of the positions. This strategy is so simple that even a junior can actually use it. But the reason Christian has been successful is his low risk versus high reward approach. We can summarize his approach to small losses and big wins. If you like this video, please subscribe and hit the like button and see my other video.